Imagine thinking you're fully compliant with your crypto taxes, only to find out your I.R.S. audit letter is already in the mail. This nightmare scenario is becoming a real threat for crypto investors, especially with the arrival of the new Form 1099-DA, starting with the 2025 tax year, filed in 2026. These forms are supposed to make things clearer. But here's the shocking truth. Relying solely on these exchange-provided forms can actually put you at a higher risk of an I.R.S. audit. In this video, you'll learn why the 1099-DA can be misleading, the crucial gaps it creates in your tax reporting, and how to build an audit-proof defense for your crypto transaction. Don't let incomplete data lead to an I.R.S. headache.
So what exactly is the 1099-DA? It's a new form mandated by the Infrastructure Investment and Jobs Act, designed to bring crypto tax reporting in line with traditional securities. Digital asset brokers like centralized exchanges will now issue these forms. For 2025 transactions, they'll primarily report the gross proceeds from your sales and exchanges on that specific platform. Sounds good, right? Here's the problem. This form only tells the I.R.S. a fraction of your complete financial story. It completely ignores your activity across different exchanges, your self-custody wallets, and especially your decentralized finance activities. This massive information gap is precisely where discrepancies arise and audit triggers are born. The I.R.S. gets one piece of the puzzle, and if your full picture doesn't match, you're in for a rough ride.
Let's talk about the transfer gap, a major trap for many. Imagine you bought 2 Ethereum tokens on exchange A for $3,000 each. Later, you transferred those 2 Ethereum tokens to exchange B and sold them there for $4,000 each. Exchange B's 1099-DA will dutifully report the $8,000 in gross proceeds from your sale. However, here's the kicker. It will likely report a cost basis of 0. Why? Because Exchange B has no record of your original purchase on Exchange A. This means, according to Exchange B's report, you made $8,000 in profit, not the $2,000 you actually made. This overstatement of capital gains can lead to a massive inflated tax bill and screams audit me to the I.R.S. You need to prove your actual cost basis, not just what the second exchange reports.
Next up, the self-custody gap. This is where many crypto enthusiasts who prioritize security can unintentionally create tax headaches. If you move your Bitcoin or other digital assets from an exchange to a hardware wallet or a software wallet, you've essentially broken the reporting chain. The I.R.S. can see you withdrew assets from an exchange, but once it's in your private wallet, it's off their radar. For now, when you later decide to move those assets back to an exchange to sell, that exchange has absolutely no visibility into when you acquired them or what your original cost was. The burden of proof falls entirely on you to provide the complete transaction history, including the original purchase date and cost. Without this, that exchange's 1099-DA will again likely report a zero cost basis on your sale, triggering the same overtaxation and audit risk.
Then we have the DeFi gap, a huge blind spot for the 1099-DA while the I.R.S. is requiring exchanges to report many common DeFi transactions are currently exempt from this new form. We're talking about staking rewards, liquidity pool transactions, and crypto lending. According to I.R.S. guidance, reporting for these activities is reportedly deferred pending further study. But here's the critical point. Just because it's not on a 1099-DA doesn't mean it's not taxable. These activities still generate taxable income that you are legally required to report. For example, your staking rewards are generally considered ordinary income at their fair market value when you receive them. If you're active in DeFi, relying on 1099-DA forms alone will lead to a significant underreporting of your income, a surefire way to attract I.R.S. attention.
Finally, let's discuss the accounting method gap. The I.R.S. in Notice 2026-20 has provided some temporary relief through December 31st, 2026. This allows you to identify specific lots of crypto to sell on your own records. This is huge because it means you're not stuck with your broker's default method, which is typically first in, first out, or FIFO. If you're smart about your taxes, you might use a tax optimization strategy like highest in, first out, or HIFO to minimize your capital gains. Under HIFO, you sell your most expensive crypto first, Reducing your taxable profit, your calculated gains using HIFO will intentionally differ from what a FIFO-based exchange report might suggest. This difference isn't a mistake, it's a valid tax strategy, but you need robust records to prove it to the I.R.S. if questioned.
All these gaps lead to one critical audit risk, the dreaded zero-cost basis. When an exchange reports your gross proceeds but a zero-cost basis, the I.R.S. computer automatically assumes 100% of that sale is pure profit. This significantly inflates your taxable income and consequently your tax liability. For example, if you sold $20,000 worth of Bitcoin and the 1099 DA shows a zero-cost basis, the I.R.S. thinks you made $20,000 in profit. If your actual profit was only $2,000, that's $18,000 of phantom income you're being taxed on, and a massive discrepancy that will flag your return for an audit. The I.R.S. expects you to reconcile these differences and provide detailed proof of your actual cost basis. Without a comprehensive record of all your crypto transactions across all platforms and wallets, you're essentially handing the I.R.S. a blank check.
So, how do you navigate this complex landscape and build a solid audit defense? The key is having a single comprehensive source of truth for all your crypto transactions. That's where tools like dTax come in. dTax supports 22 different blockchains, including 16 EVM chains like Ethereum and Polygon, plus Bitcoin, Solana, and more. It lets you import data from 29 different exchanges, including Binance, Coinbase, and Kraken, ensuring every transaction is captured. Crucially, dTax offers 13 different cost basis methods, including FIFO, HIFO, and specific identification. And its best method, Optimizer, can show you which one saves you the most money. It even has a pre-audit sandbox that scans for 6 I.R.S. audit risk categories before you file for audit defense. dTax generates an audit defense PDF, a full transaction register with on-chain provenance, providing the I.R.S. or your CPA with undeniable proof. Check out getdtax.com. It's open source and free to start.
Let's tackle a couple of common questions about the 1099 DA first. What if my 1099 DA shows a zero-cost basis, but I know I have one? You absolutely must correct this. You'll need to manually adjust your cost basis on Form 8949 and attach a statement explaining the discrepancy backed by your transaction history. This is exactly why comprehensive record keeping is non-negotiable. Second, does the 1099 DA apply to NFTs? Generally, yes. Sales of NFTs are considered digital asset transactions and would fall under these reporting requirements if conducted on a platform that qualifies as a broker. However, the specific details for NFTs might evolve, so always stay updated on the latest I.R.S. guidance. The main takeaway is that you are responsible for accurate reporting regardless of what an incomplete form might suggest. The new 1099 DA forms are a wake-up call for crypto investors while they aim for transparency. They introduce significant complexities and audit risks if you rely on them blindly. Your key takeaway should be this: a complete, accurate, and independently verifiable record of all your crypto transactions is your best defense against an I.R.S. audit. Don't wait until it's too late. Start organizing your crypto tax data now. Thanks for watching, and I'll see you in the next one.